Hi everybody, it's David Fleming here from the Toronto Realty Group, and welcome to part 2 of my interview with mortgage broker Tony Della Sciucca. Now, hopefully you watched part 1 on Wednesday, otherwise maybe this video doesn't make quite as much sense, but we had some amazing questions from the readers. I think there was like 15, 16 questions, hence why we divided this into 2 parts, because who really wants to sit down and watch an hour of me and Tony? Am I right? Anyways, guys, let's pick up exactly where we left off on Wednesday. Enjoy.
So JL, a name I recognize, he asked a follow-up question. Or even more generally on this, what trends, responses have you seen in the mortgage market from clients in terms of behavior and demand volume as each of the rate increases got rolled out over the last several months? Has there been any variability to these trends, i.e. the more drastic drop early, the more drastic drop, is that right? Drop is an increase, or drastic drop with the most recent increase? Or has any reduction followed more of a steady straight line path?
Yeah, so I think what we're seeing is there's a psychological behavior now that's happening out there in the market, and you might be feeling this as well too. I think, Dave, a little bit is there is this sense of pause with people trying to figure out what's going on. And 6 months ago or a year ago, if a property was listed at $1 million and you had to get someone to pay $1.05 million to acquire that property, people wouldn't bat an eyelash. In today's world, that's just not happening. So no one wants to overpay. No one wants to put themselves in a position where they feel they're getting a property for more than what it's worth. And people are just naturally apprehensive now, and as they should be. They want to just figure out where this sort of real estate market is going to kind of flatten itself out, I guess maybe you should say. But the sentiment has changed from definitely 6 months ago when, every purchase that we saw was scratched out 5 or 6 times with a higher value. In today's world, we're seeing conditions come back. We're seeing people just kind of take their time before pulling the trigger on properties.
Okay. So let me follow up on Adam C. and JL's questions. Is there a scenario where, and this goes into the whole pre-approval and rate hold, is there a scenario where you've got somebody and they are pre-approved for $2 million, and the rates go up and you say, hey guys, you can now afford 1.92?
Yes.
Simple answer. Wow.
The short answer, I mean, the simple answer is yes. There are individuals who have pre-approved themselves maybe 5-6 months ago, and now they're coming back to re-qualify again, and they just don't qualify for what they did 6 months ago. And it's prevalent in individuals who are putting less than 20% down, where their carrying costs have been significantly reduced because of these stress tests. So the short answer is yes. You want to make sure that if you're pre-approved and interest rates continue to climb, that you're getting reapproved again. And the primary reason is the stress tests are constantly changing. So until the governing bodies figure out how to implement better stress tests, you're going to continue to see people that were pre-qualified for a certain dollar amount 3-4 months ago, and now it's going to be less than what they were originally qualified for.
Another name I recognize, East Yorker, which I assume is somebody who lives in East York. Otherwise, it's a very misleading name. With the variable rising and bonds falling, will there be a scenario where fixed rates are lower than variable? East Yorker.
Here's your question.
I feel like we can hang out on weekends, buddy.
Yeah, the answer is in, what was it, Dave, 2020?
Yeah, that was me, East Yorker. Thanks for that.
Yeah, so I think East Yorker, to answer the question is, historically speaking, variable rates are generally lower than fixed rates. They're typically priced at about a spread of 120 to 130 basis points. And again, the main component between these rates is penalty calculations, which I think are very important for some people. So variable rates have 3 months interest penalties. Fixed rates can either be 3 months interest or what's called an IRD, an interest rate differential. So if you have the foresight to think about where rates are going to be and you're moving or doing something, it becomes very important to know what kind of breakage fees you're going to pay at that time. And variable rates are great because you're always guaranteed to pay a 3-month interest penalty if you break that mortgage. So
second part of his question, or her, if we are heading into a recession, that usually means lower rates. What has to happen for variable rates to lower? I feel like we've covered this, but specifically the idea of when in recessionary times, and now you're getting into fiscal monetary policy. How does the government react if we're in a recession to stimulate the economy? like
Sure.
selling rates?
Yeah, this might be a little bit over my head, but I mean, the reality is, in order for rates to come down, there needs to be an amount of demand that comes down. And a prime example would be if you have a property that's listed for $1.5 million and you have no offers for 1 week, 1 month, 2 months, 3 months. At some point in time, you're going to reduce that purchase price. Similarly, people who are experience this sort of inflation where you go to the grocery store, things are more expensive. You go pump gas, it's more expensive. You want to travel, it's more expensive. At some point in time, people will eventually scale back because their mortgages are becoming more expensive. And the things that take the hit first are those external habits or hobbies that people have, because at the end of the day, you want to be able to make your mortgage payment. So in order for the recession, which we're probably in the midst of right now, for rates to come down, is there has to be a slowdown in demand. And we're beginning to see that now. People are beginning to spend less.
And so I've been making notes about questions I want to ask at the end. It all comes back to this fascinating concept of inflation, which perfect timing. Next message from Vancouver Keith. I think I told you, I don't know if Vancouver Keith is a shit disturber or not, but the way that he wrote this, I love it. I have a question for Tony. Do you believe that inflation is everywhere and always a monetary phenomenon or not? Defend your answer. I love this guy.
Well, I'll be a little bit rhetorical and condescending with Vancouver Keith at the same time. I guess my question to him would be, if you've walked into a grocery store, are the items you're buying more expensive than they were 2 months ago? If you went to go pumping gas last week, is it more expensive than it was 2 weeks ago or 2 months ago? If you've gone traveling somewhere, is it more expensive or less expensive than it was 2 years ago? Real estate, if you bought a property 3-4 months ago, was it more expensive or less expensive? The reality is inflation is around you. You can feel it, you can sense it. So I think that the answer is yes, it's here. It's evident and it's around us. I mean, the short answer is go pump gas, go buy groceries. Things are more expensive. Your dollar is not stretching as much.
So I'll tell Vancouver Keith, I learned about inflation in 1988, okay? A package of 1987 Topps baseball cards was 25 cents. And in 1987, I used to go when there was a Looney. Okay, the Looney came out in 86. So I would go to the Looney, I would put it down on the counter, and I would show them 4 packs of baseball cards. I could do math, 25 cents times 4. And I would go sit on the steps. This is at the, I don't know what it's called now, but this is in Leaside at the corner of Sutherland and McRae for anyone who cares. In 1988, April, okay, New Year, I walked up and I gave them a Looney with 4 packages, and they looked at me and said no. And I said, what? And they walked me over and they showed me that it was 35 cents. Now, I couldn't do the math because they weren't quarters and it wasn't brilliant at 7, but 35 cents. And I didn't understand it. I went home and I said to my dad, it's so unfair. They're charging 35 cents for cards right now. My dad said, David, that's called inflation. And I said, what? And he said, sometimes things end up costing more as time goes on. And I learned this, like, it's so silly, Tony, but like, I learned this when, and we're starting to date ourselves here, at least I am, when a chocolate bar was 50 cents. That's what it was. Okay, it was always 50 cents. And then you walked in one day, and it was 60 cents, 75 cents, and then it was $1. I don't even know what a chocolate bar cost now. It's probably like $3. But that's just a simple reality. I learned this at age, well, actually I was 7.5. So Vancouver Keith, yeah, I mean, inflation is everywhere, and it's always a monetary phenomenon. And always going to see it, and it's never going to change.
Yeah, and I think what's important to notice is, when inflation is happening so quickly, it's not happening in other elements of someone's life. So, for example, your income is not going up at the same rate that inflation is going up. So there's this imbalance of how quickly things are rising and escalating that's not translating into income levels as well, too. Because at the end of the day, if prices are increasing and your income is not, that's a problem.
Yeah, I'll give another example, not to belabor this point. But we didn't really go out at all during the pandemic, right? A lot of people did, weren't accustomed to dining. And I made this point in my blog. I went to the keg with my wife and my daughter. My buddy was at home, my 2-year-old was at home with my mom, I guess. And this, I gotta think, was maybe like March or April of this year. Now, I don't generally look at prices on menus. I don't want to sound like a jerk. But like, I don't care, this stake versus that stake, unless we're at somewhere where I would never go, right? Tell me like Jacob or something like that. But this is the cat. So I looked. I always get the New York peppercorn. I've always got it. I get the French onion soup. I tell myself I don't want bread and butter, and then they bring it and I eat the entire thing. But I always get the New York peppercorn. It was $52.
Sure.
And I thought to myself, this was a $35 or $36 steak before the pandemic. That, folks, is when I felt inflation. And labor costs more, the people working there, right?
Everything. I mean, you got to get the food to the table. I mean, people got to deliver the food. There's gas price. Like, it's so intertwined where you at the end of the day, as a consumer, you look at one thing and say, my banana costs $40 or 40 cents more expensive than it did 2 years ago. But there's all these little intricacies of how it needs to get there and who's involved. And it's quite high. I mean, to think that things are escalating and rising at an 8%, quite almost an 8% increase, it's scary.
Yeah, and sometimes you don't notice it until it's...
You don't.
That steak example is the first time I really felt inflation.
Yeah.
Okay, so RPG, another name I've seen over the years. I'm sure it stands for something. And hopefully not a rocket-propelled grenade. I was thinking maybe it was someone's initials. Or this guy's just a rocket. When variable rates increase... Oh, this is good. I talked to you about this last week, and you mentioned it clear. When variable rates increase, does the payment increase or just the balance between principal and interest? And you touched on this about 15 minutes ago, and you said different banks do it differently. So please walk us through an example. Yeah,
this is a great question. I think everybody should make sure that whoever their mortgage is with, that their institution clarifies how their payments work. So there are specific institutions. Scotiabank, for example, is an institution that has what's called an adjustable rate mortgage, where as the prime rate increases, your payment will increase. And as prime rate decreases, your payment similarly will decrease. TD does not have that same adjustable rate mortgage. They have a variable rate mortgage where your payment is static. So your payment does not change during the course of the term unless you hit something that's called a trigger point. And this trigger point is typically anywhere from 200 and 250 basis points higher than your original rate, which basically tells the bank, if you hit this trigger rate, you are no longer giving us enough money in interest, and you could, in theory, have what's called a negative amortization, and therefore we need to increase your scheduled payment by whatever that number is. They'll tell you what that figure is. But two different institutions that sort of calculate payments differently for their consumers. The benefit with a variable rate with, for example, TD's, people liked the fact that their payment was static and it didn't change. So they didn't feel the pain of the prime rate going up and their payment was changing. The problem with that is you have to be on top of your payment. You'll hit with trigger rate and then your payment will increase to keep in line with the amortization. And then, like I mentioned earlier, Scotiabank will fluctuate with your payment every time the prime rate changes. So very good question. Depending on the institution you're with, you want to make sure that you're asking them whether you have a static payment or an adjustable payment. And just for every time, I think we touched on this, every time the Bank of Canada when they increase the variable rate by a full percentage point, that translated to an increased payment of about $540 per million that gets adjusted on your payment. So, quite a bit. And that's on a 1% rate hike. So if they've hiked it 225 basis points, that's approximately almost $1,200 in increased payment that you would have made since March per million mortgage. So quite a bit.
Yeah. Okay.
But great question.
I think someone's getting me a coffee. Okay, so Andrew Canis. Here's what I got to confirm because it was Adrian C. No, hold on. I'm going to scroll back.
Andrew C.
Adam C. Adam C. Andrew C. Andrew Canis asks. Canis is Latin for dog. I took it in grade 9. And OAC. See what I mean, Tony?
There isn't more OAC. Is there these days?
No, there isn't. There's only grade 12. But I don't
know
why people watch my videos. I don't know. It's just a cornucopia of useless facts from my childhood. So Andrew, the Latin dog, Canis, says, have you seen any appraisals fall short when getting final mortgage approval before closing? Will this cause the bank to reduce the size of the mortgage and force the buyer to pay a bigger down payment than expected? Oh, Tony, scare the pants off them right now because that's what they want.
Yeah, I mean, the answer is we've seen, or I've personally seen one in the last, I think, 3 months, but they were putting enough of a down payment where the shortfall was offset by how much they were putting down. It's very important if you are purchasing a property that you begin putting in financing conditions in today's market because of how quickly home prices are de-escalating. And in order to protect your deposit, you want to make sure that your appraisals are ordered right away within the financing condition term that you have. And ultimately, you want to speak to your realtor and just make sure that the property you're buying is going to appraise at what you're purchasing. Because if there's a shortfall of, I'm going to use a standard number here, you buy for $1 million and it's short 100,000, and you're putting 20% down, you need to make up 80% of that shortfall on closing. And when you factor in things like land transfer tax, closing costs, legal fees, you need to be prepared to have that money on hand, or your deposit is at risk.
Yeah, so I'll tell you, I had a situation where a client bought for $3 million in the first week of April, and we have an August closing, and they did not get an appraisal done. And it took some time to figure out lenders, lending, so switch lenders 3, 4, 5 times. This week, the lender goes to do an appraisal. You and I both know $3 million in April is not $3 million approaching August. You know what the appraiser appraises at?
I'm going to say 2.6, 2.7.
$3 million. Wow. It's not worth it. Look, the appraiser, he knows the game, okay? And I don't mean appraiser on the block because he has standards. But it felt to me like this appraiser was just doing the. Like
Sure.
the bank wants to lend the money, they appraised it. Or maybe, hold on, maybe, Tony, maybe. You ready for this? I was doing a drum roll.
Maybe the house was worth $3 million?
I was going to say, maybe they had such a good real estate agent that we got it for $3 million when it was worth 3.3. Now it's gone down from 3.3 to $3 million. Boom.
Sorry, did you say the initial price was how much?
The initial price, we paid $3 million in April, and they just appraised it for $3 million. So that could only mean, folks, that I got
the right guy
of the century. Hang on one sec. I gotta do it. Mic drop.
There it is. You heard it here first.
I keep this for effect. This is just to do mic drops. I am that crazy. Okay, so Tony, we have 2 more questions, okay? Hank asks, here's the personal finance questions. It's now a good time to switch to a 3-year fixed rate that is around 4.75 to 5.14. There's 3 questions here. Will variable reach 7% net of discount? During a recession, will interest rates go down? So we've covered the last point, but he's asking a personal finance question.
Yeah, I mean, look, anytime someone says, should I take a shorter term than 5 years, a 1 year, 2 year, 3, what you're essentially telling me is I think interest rates are going to be cheaper at that time period when I have to renew. Again, the answer is if you're comfortable making a payment at 4.75 or 4.69, whatever that number is, then you should convert. No one really knows where interest rates are going to be in 3 months, 6 months, 3 years. But at the end of the day, if there's some type of incentive for you to inherit that rate and it's affordable for you, you should take it.
I think that's a pretty easy answer right there, right? Okay, and second question, will variable rate reach 7% net of discount? I don't know what that means.
Net of discount. So I think the answer is pre-discount. I think the answer is no. I don't think you're going to see prime rate get that high. We're at 4.7. If we buffer in another 0.5 point to 3/4 point rate hike again in September, I think that's probably when they're going to call it quits. It's hard to say, but my prediction is you're going to see variable rates jump, I would say another 50 to 75 basis points until the end of the year, and then begin to settle down for a little bit. So, I don't like to use the word pain, but I think there's more increases to come, which may cause a little bit of pain for consumers who are looking to renew into mortgages. Because keep in mind that people who have fixed rates or variable rates that are coming up for renewal in the next 3 to 6 months are going to be renewing at significantly higher rates. So their payments are going to increase significantly. If they were sub 3%, And now they're getting into fixed rates of 5.5 almost. So people are going to be in for a little bit of a rude awakening when these new renewal rates come up. I had one today. Rate was 5 years ago was 299, and now renewal terms are 529, and they have their arms up in the air saying, like, what do we do? And you have to pick a rate, and if they want to buy a payment, then the payment is lower on the variable for now. But they've got to be prepared to assume the risk, and the risk is that your rate is going to get more expensive in a few months.
Okay, so our last question is on Instagram. Will rates be higher in 4 years? Wait, will rates be high? This person's name is Mint Chocolate Chris.
Mint Chocolate Chris?
Mint Chocolate Chris. I guess this is on Instagram, so your name doesn't have to be Tony Della Sciucca.
Sure.
Mint Chocolate Chris. I guess mint. That was a pretty hot flavor in the 80s. Mint chocolate chip. Do you remember that?
I never understood the mint with the chocolate. I think you just.
But like after eight mints, right? Like the chocolate and mint. No, you never got into after eights back then.
No, I think it was just like you just straight up chocolate and that was it. Maybe kept it simple.
Didn't you eat Junior Mints? Those were huge in the 80s.
Every time I think of Junior Mint, I think of the Seinfeld episode when Kramer dropped that Junior Mint into the operating room.
He goes, let's sew them up. Remember that? Oh my God. Okay, well, mint chocolate chip. That was a huge flavor back then. What's your go-to? What's your Baskin Robbins go-to?
If there's some kind of like hybrid, like Nutella or pistachio or something, that's.
He doesn't know Baskin Robbins. There's 31 flavors, bro. They don't change. Okay.
I don't know.
I'll tell you what I'll do right now. Okay, for those of you that have made it this far, I give a $100 Tim Hortons gift card to whoever can tell me my favorite / the only type of ice cream that I will ever eat. I don't like ice cream, but at Baskin Robbins, of their standard 31 flavors, there's one of them. Post it in the blog comments, and I'll connect with you.
$100 gift card to Tim Hortons. I'll tell you what. If they guess it, I will add another 100.
What? $200?
$200.
That's amazing. Okay, so back to mint chocolate Chris.
All right.
And it's not mint chocolate chips. So there, you're down to 30.
Okay.
Back to mint chocolate Chris. See what I mean about the tangents, but they're fun. He asks, mint chocolate Chris, his Instagram is blowing up. Mint chocolate Chris asks, will rates be higher in 4 years given the prospect of a recession next year? So 4 years from now, he's just asking, and they could go up and down. They could go down and then back up. 4 years, Tony.
Mint chocolate Chris. The answer is I probably don't want to hear this, but I don't know. It would be the equivalent of rolling down your window at the gas station and saying, "Hey, can you tell me what the pumps are going to be like in 2029?" Nobody knows.
You know what? Another story that has nothing to do with anything. Summer of 1998, I worked at Sciucca, and you know what they say? Like pumping gas when you're in school, they're like. The teacher's trying to shit talk you, and they go, yeah, if you don't get your act together, you're going to be pumping gas one day. That was one of the best summer jobs I ever had because, number one, I started at 6 a.m. It taught me to get up early in the morning, and I was finished at 2 o'clock. Then I went home and lifted weights. This is when I was 18. Then I went and did karate. It was the most amazing summer, and I was outside and I worked on my tan. Okay, what was gas?
I remember gas when it was like 39 cents. And not to like top your story, but I remember as a kid, everything was self-serve. Everything was self-serve at the time. So my dad would roll down the window and he would give like the attendant like $20 or $10, and the attendant would pull out this wad of cash and it would just like put it in the specific spot where all the 10s were, the 20s were, and I would look at mom. I'm like, oh my God, Mom, this guy has so much money. I want to be a gas station attendant when I get older. And she would look at me like, no, you don't, honey. You can do a little bit better. And I'm like, no, look at all the money he has. And every time we'd go to the gas station, I'd always like kind of peek and see how much cash was there. But I had no clue how the system worked back then.
Tony just missed the part where I said that I worked at a gas station. No, it was 49.9. So people would roll up. And they'd go, 49.9 was the lowest ever. And people would roll up and it would be 52.9. And they'd go, they go, hey, what's happening with the price today? So, and like, look, maybe it was my upper middle class upbringing, but 2 cents on a liter and you're going to make a special trip. I never understood it. The highest I ever saw was 54.9. The lowest was 49.9. But people would yell out the window and they would ask us, what's happening with the gas? Because I used to change the numbers on the sign. because it was not automated. But literally, if we're 49.9 instead of 53.9, you're going to come later on. 50 liters in a tank for 3 cents a buck 50, dude. You've got to be kidding me. I mean, times are tough, but they can't be that tough, right?
Well, look, there are people who just like, saving a little bit of cash.
So mint chocolate crisp. Did you get the
Mint chocolate crisp? Not to be rude, but I wish I knew where rates were going to be in 3 weeks, let alone 3 years or 4 years. So it's hard to say. What I can tell you is I think there's a consensus that they're trying to normalize and stabilize interest rates in and around mid to high threes, I think is the ballpark that they're trying to get it at. We benefited from a very, very low rate environment for a very long time. And, the party's over. We're sort of in an environment now where interest rates are very expensive and inflation is high. And I think a lot of this is where interest rates are going to be is going to be predicated on how quickly we can get inflation down. I just don't think we're going to see it come down as quickly as it went up. My prediction is probably going to take about 18 to 24 months maybe before we start seeing a big impact in interest rates. So just some food for thought on my end.
And inflation. And we're running out of time here, folks, but the last thing I'll say is I had a theory, and it goes like this. Inflation is based on consumption, it's based on demand. When the pandemic began, we all signed up for Amazon Prime because we weren't supposed to go out, we weren't supposed to, social distancing, stay at home. Everyone in North America, everyone in the world got Amazon Prime. So not only did we buy stuff that we needed, but we bought stuff we didn't need. And if you ever bought anything off Instagram, I'm not gonna lie, I bought some shorts, like they always show some really cool dude who's just ripped through the shirt. You're like, I need that shirt, right? Everything's at our fingertips. And then grocery gateway and delivery and Sobeys, we've been doing that. I think that the pandemic, obviously we cut interest rates because of the pandemic, and that obviously had an effect. The government started printing money, handing out money. And again, I know people fell in desperate times and I know that they needed it, but we caused this inflation 100% with our actions. And if you look at a chart of inflation over the last 20 years, it's like this, and then it just spikes. And this is because of the pandemic, and this is because our purchasing power and our purchasing mediums have changed. And it's also because, we're just not addressing it quickly enough.
Yeah, and it's quite frightening because we're seeing a lot of situations where employment is very low, and there's a huge labor shortage, and there's still a lot of supply chain disruptions. And you look at countries like China that can just shut down a city of like 20, 30 million people because of outbreaks of COVID. It's scary stuff. I mean, what used to cost a container to come to Canada for services and goods, $3,000 to $5,000 is now $30,000, $25,000. So you're renovating a house, the price of lumber has doubled, concrete doubled. It's very expensive.
Yeah, and so I've said that I think it's going to take to see, and I watch every month. I look at the stats that StatsCan sends out. I think that it is going to take 6 months to see any impact in inflation at a minimum. And so you're going to see rates continue to increase, and inflation will continue to increase, and people say, "What is happening?" But it's going to.
Let me ask one last question before we sign off. If I had to get your prediction and your guess on where you think this real estate market is going to land in 3 to 6 months, your prediction would be?
3 to 6 months. So I'll use an analogy. People talk about the dust settling, okay? We're in this period of uncertainty right now. Nobody knows anything. It's all guesswork, right? And if you're looking to buy a house and you're nervous you have to sell your house, how long is it going to take? What are you going to get for it? I think that August is going to be very slow and there's not going to be a lot of activity. September is when we're going to know what the market is. Yeah. Because every year in September, listings explode and buyers are there. If the buyers are not there when we get the September stats, then it's going to lead to a very slow fall and prices are going to come down. As far as, you're talking 6 months, let me say this. If we go forward, let's say 9 months, and we're into April of next year, which is like usually peak season, I think it's going to have picked back up. I think the market is too resilient, despite interest rates, okay? And I know I'm in sales, so I'm going to say that. The market in Toronto is too resilient. You give me 9 months, we're not back to where we were average home price, 1.334, but we are back on the upswing. And if you look at 2017, the average home price was in April somewhere around $920,000. And when the market dropped, it took 3 full years, April of 2017 until June of 2020 to get back to there. I think that's what's going to happen with that 1.334 price. But I do think that the market will normalize and balance by next April.
Okay, good to know. And look, I think there's still a lot of buyers out there that, for whatever reason, could not enter the market 6, 7, 8 months ago, and have been sitting on the same cash, the same capital, and they may find a property currently right now that might be 15, 20, 30% discounted than they were previously looking for. So I think there's a big enough pool out there where in the next 3 to 6 months, I think at some point they will make a decision to enter the market.
There you have it, folks.
Yes,
Tony, that was awesome. We spent a lot of time on this. Thank you so much for doing this.
Yeah, no problem. My pleasure. Let me know if there's anything we need to, like another question to revisit, or there's some pauses or something, and we'll just kind of clip it in or whatever. But thanks for having me, man. I love this stuff.
You know what? Maybe just jump on the blog to the readers. If you guys have any follow-up questions, I'll ask Tony. You know, clearly neither of us are busy, right? Jump on the blog on Wednesday if people have some follow-up questions. I think you did that when we did this in 2020.
Yeah.
And maybe just answer a few of the questions.
Love to. Love to.
Okay. Awesome. Guys, we're signing off. Thanks so much, everybody.
Thanks for having me, guys. All right, see you, Dave. Bye.